What if I told you that you can trade hundreds of thousands of dollars worth of gold at a 90% discount? And no, this isn't crypto or some new scam. It's how professionals trade commodities every single day. Today, we're talking about futures trading, specifically gold and silver, and why this might be one of the most overlooked markets in finance. You see, most people think investing means buying stocks, ETFs, or real estate. But almost nobody talks about the market that literally sets the price of gold, oil, food, and energy. The futures market is where price discovery happens. And here's the part that caught my attention. You don't need to pay the full value for the asset. You can put up 3 to 10% of the total value and profit or lose based on the price movement. That's leverage. Powerful if you understand it, dangerous if you don't. A futures contract is simply an agreement to buy or sell an asset at a future date at a price agreed on today. You can trade gold futures, silver futures, oil futures, corn futures, and more. But here's the key takeaway. Most traders never take delivery. Because you're not buying actual gold bars, you're trading the movement in price. Let's use gold as an example. Standard gold futures equal 100 troy ounces, and micro gold futures equal 10 troy ounces. So, if gold is $5,300 per ounce, a standard contract is $530,000, and a micro contract would be $53,000. Now, this is where people's minds start to bend. You don't actually pay $530,000. You post what is called a margin. Think of it like a security deposit. That margin might be $20,000 to $25,000 for a standard contract, and a few thousand for a micro. There are even some platforms that let you trade smaller amounts for a margin of a few $100s per contract. Once you're in, you're trading the difference in price. If gold moves $1, a standard contract moves $100, and a micro contract moves $10. If gold moves $100, that's $10,000 on a standard contract. That's why futures are exciting, and why they require discipline. Now, there are two ways you can enter an options contract. You're either going long or going short. Going long means you think price is going up. Going short means you think price is going down. And futures make shorting just as easy as going long. No borrowing shares, no weird mechanics. You're simply betting on direction. Now, gold isn't just a metal, it's a fear gauge. Things like inflation, interest rates, wars, currency weakness, all affect price movement. When uncertainty rises, money flows into gold. Silver is even more volatile because it's both a monetary metal and industrial. Here's a clean, beginner-friendly way to think about trading futures. Identify the trend. Is gold making higher highs and higher lows? Find prior resistance. Example, gold struggled at $5,100. Watch for breakout. Once it clears resistance, that level often becomes support. Wait for pullback. Don't chase. Let price come back and prove support. Enter with a stop. Decide how much you're willing to lose before you click buy. You're not predicting, you're deciding. Here's the most important thing I want to share with you. The margin is not your max loss. Losses are actually settled daily. If price moves against you and you still have enough margin, you stay in. If not, a margin call is made, and your position is closed. Think of a margin call like the barkeep at the end of the night coming to settle your tab. If you have the money to cover it, your tab can stay open. If you do not, you get kicked out. That's why I always recommend starting with micro contracts. Futures are not for everyone, but they are powerful for high-income earners, active investors, and people who study markets. This is not set it and forget it. This is intentional trading. Futures are not magic, but once you understand margin, leverage, and price movement, you realize this market has been hiding in plain sight. If you want the next video to break down gold versus silver strategies, futures versus options, or how professionals manage risk, drop a comment. And if this helped, subscribe. We're just getting started.